Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at super microcomputer.
If you find our talks useful, please consider subscribe, like, and comment underneath. And real quick, don't forget to grab the VIP Algos link down in the description below. It's a great tool. Highly recommend checking that out.
Yeah, definitely take a look at that link below. It's super helpful.
Okay, so I want you to just imagine for a second that you're looking at a financial chart on your screen. On the left side, you've got this like sleepy, slow-moving utility stock, right?
Right, the kind that manages a regional power grid or something. Safe, boring.
Exactly. Safe, predictable, trading at a super low multiple. Then on the right side of your screen, you pull up this tech company that is growing its top-line revenue by more than 56% year over year.
Which is just a massive number.
Right, and they're sitting dead center in the middle of, honestly, the most aggressive technological arms race of our lifetime.
Yeah.
You'd expect those two charts to look completely different.
You would assume the tech company is trading at an absolute premium, like a luxury asset.
Yeah, but looking at the data for our talk today, the technicals, the preliminary earnings, all these analyst notes, that hypergrowth AI tech company is priced almost exactly like the boring utility stock.
It's a massive structural disconnect in the market right now.
It really is.
When you look at the raw numbers, it kind of forces you to completely reevaluate how Wall Street is, calculating the value of growth versus their fear of cyclical downturns.
And unraveling that disconnect is basically our mission for today. We're looking at supermicrocomputer, ticker SMCI. And the narrative here is just wild.
It's fascinating.
We've got this AI infrastructure builder sitting on it, and this number is crazy, a $60 billion order book.
Yep, 60 billion.
While they're going through this violent upward shift in profit margins and simultaneously dealing with some pretty serious geopolitical headwinds.
Right, so the big question is this a generational value opportunity, or is it just a really brilliantly disguised value trap?
Yeah, exactly. Because, normally when a company shows 56% year-over-year revenue growth, Wall Street prices in, like, decades of flawless execution.
Oh, totally. They price it to perfection. But here, we have a central player in the AI hardware supercycle just sort of lingering in the bargain bin.
So to figure out why, we need to really break down the mechanics behind that $60 billion backlog, right?
Yeah, and we have to understand the actual physics of how they're changing their profitability. Plus, obviously, interrogate the macro risks that have all this institutional money acting so cautious.
Right. So let's start with the sheer scale of the demand, because honestly, you don't see a stock drop 50% from its highs without some major fear in the water.
No, I don't.
But then the top-line numbers are telling the story of just unbridled expansion. Trailing 12-month revenue growth is at 56.24%.
Which, again, is huge for hardware.
Yeah, but the number that really jumps off the page in the preliminary Q4 updates is that $60 billion in new AI orders.
And I think we really need to give that figure some context.
Please do.
Supermicrocomputer's entire market capitalization, so the total value of all its outstanding shares, is sitting at roughly $19.73 billion right now.
Wait, so they're holding an order book for new infrastructure that is what? Roughly 3 times larger than the entire value of the company itself?
Exactly. It completely breaks traditional financial models.
That is insane. In the past, people would call this the classic selling shovels in a gold rush setup. But I actually hate that cliche.
Just a bit tired, yeah.
It feels too small.
Yeah.
We aren't talking about basic tools here. Everyone is fighting over the AI software, right? The massive language models.
Right, the front-end stuff.
Yeah, but Supermicro's out there building the high-voltage transmission lines and the physical substations of a completely new digital grid.
The digital grid analogy works perfectly here because they're physically assembling these rack-scale systems, engineering the thermal management, pouring the literal architecture that houses these incredibly sensitive AI processors.
So the software gold rush is essentially creating a forced infrastructure build-out.
Exactly. But let's play devil's advocate for a second.
Oh, I'm ready. Let's push back on the enthusiasm.
Because having 60 billion in orders looks fantastic on a press release. But if I run a business and I sell 1 billion units of something, but the cost to build and ship those units eats up all my revenue.
You're just speeding up your own bankruptcy.
Right. Capturing massive volume doesn't automatically mean you put actual money in the bank. So are the costs to build these highly complex supercomputers just too high to turn a real profit?
See, that is the fundamental reason this stock has historically traded at such a depressed multiples. What you just described is the ultimate hardware trap.
Yeah, it's a brutal industry.
It is. Historically, Supermicro just functioned as a commodity assembler, and they suffered from severely compressed profitability.
How compressed are we talking?
Well, looking at their trailing 12-month data, their gross margin averaged just 8.39%, and their net margin was an incredibly thin 3.7%.
Okay, let's unpack that. A net margin of 3.7% means for every $100 of that massive headline-grabbing revenue, they're keeping just $3.70 as actual profit.
Exactly, $3 and change. One tiny disruption in the supply chain, or a slight bump in the cost of copper, or a shipping delay, and that profit just vanishes into thin air.
And that razor-thin margin convinced Wall Street they had zero pricing power.
Right.
The assumption was that Supermicro was just taking whatever leftover scraps the massive tech giants allowed them to have, perpetually caught in this race to the bottom.
But that's where the preliminary Q4 results come in. They delivered what industry analysts are actually calling a massive margin shock.
Okay, what exactly did those preliminary numbers reveal?
So the company had previously guided for gross margins to stay in that familiar 8.2 to 8.4% range, right?
Sure, the usual.
Instead, they reported gross margins expanding violently upward. They landed somewhere between 15 and 17%.
Whoa, doubling a gross margin in a single quarter is, that's practically unheard of in physical manufacturing.
Right. Moving the needle by a single percentage point is a huge victory for a hardware company.
Jumping from 8% to 17% implies they basically found a completely different business model hidden inside their own factories.
Yeah, exactly.
How does a historically weak hardware assembler suddenly gain the leverage to dictate terms and double their profitability like that?
What's fascinating here is the underlying mechanism of that shift. It proves they aren't just selling individual commoditized server boxes anymore.
They're doing something else.
Yeah, they've transitioned to selling fully integrated high-performance AI rack-scale systems.
Oh, I see.
Instead of handing a client a box of expensive puzzle pieces, they're delivering a fully assembled, turnkey supercomputer.
And because those integrated racks are so incredibly complex to build and test, they can finally command a massive premium.
Exactly. They're moving from just churning out volume to exercising actual pricing power.
But if they're suddenly pulling down 15 to 17% margins in a space that is filled with massive legacy competitors, what is their actual competitive moat?
That's the billion-dollar question.
Right, because if it was simply a matter of snapping parts together and hiking the price, companies with endlessly deep pockets would just do the exact same thing.
Yeah, their moat is built almost entirely on engineering agility. It's all about speed to market. They utilize this highly modular design philosophy across their entire pipeline.
Meaning what, exactly?
Well, when a silicon designer like an AMD or NVIDIA finalizes a new bleeding-edge chip, Supermicro is structured to be the very first to integrate it into a stable architecture that can actually be deployed.
Got it. I actually saw an analyst note comparing them to a custom race car builder operating out of a high-tech garage.
Oh, I like that.
Yeah, and contrasting them against a massive legacy automaker like HPE. The legacy automaker has factories the size of small cities, right?
Right.
If they want to integrate a next-gen engine, they have to spend 2 years retooling massive assembly lines.
Oh, yeah, the bureaucracy alone.
Exactly. But Supermicro, being modular, can swap that new engine into their chassis overnight, adjust the cooling, and get it on the track before the legacy players even finish drafting their blueprints.
And that speed difference is exactly why they're winning these high-margin contracts. In the AI arms race, time is quite literally billions of dollars.
It really is.
We can see this in their recent product launch, too. The H15 server portfolio, which is built around AMD's 6th-gen EPYC processors.
Let's talk about the specs on that, because the technicals highlight exactly why they're pulling away. The data shows 33% more cores, double the PCIe bandwidth, and 2.6 times higher memory bandwidth compared to previous iterations.
Right, and I see those technical specs constantly in these reports, but I think we need to break them down so the actual utility is clear.
Sure.
Like, I get that 33% more cores means having more individual workers inside the chip processing the math simultaneously.
Right.
And PCI bandwidth acts as the internal nervous system, dictating how fast the processor can talk to the graphics cards. But memory bandwidth always trips people up.
It's tricky.
If you already have the fastest processor in the world, why does memory speed matter so much?
Think of it like A 10-lane superhighway leading into a city. The highway is your processor, right? Capable of moving a massive amount of traffic at blinding speeds.
Okay, fine.
But if the exit ramp into the city only has a single lane toll booth, the traffic backs up for miles.
Oh, that makes sense.
Yeah, the processor just sits there idling, waiting for data to arrive. In AI workloads, you are moving terabytes of data constantly. By offering 2.6 times higher memory bandwidth, Supermicro is effectively demolishing the toll booth.
So they ensure the extremely expensive chips the clients are buying actually run at full capacity.
Precisely. And there's another critical bottleneck they're solving here too, thermal dynamics.
Oh, the heat issue.
Yeah, when you pack dozens of these next-gen processors into a single server rack, the physical heat generated is astronomical.
Traditional data centers just use massive air conditioning units, right? Basically blowing cold air around a room.
Yeah, but that no longer works. It literally cannot remove heat fast enough to stop the chips from melting.
Which explains the massive pivot to liquid cooling that we've been seeing.
Exactly.
Yeah.
Liquid cooling absorbs heat directly at the chip level, pulling it away through a closed loop. It is incredibly complex to engineer at scale without risking leaks that could, destroy millions of dollars of hardware.
Yeah, water and supercomputers don't usually mix well.
Right. But because Supermicro aggressively pursued liquid-cooled architectures early on, they have a massive head start.
And that head start is what brings us to the hyperscalers, the massive cloud providers like Amazon, Microsoft, and Google.
The big guys.
Right. Historically, those giants designed their own bare-bones server racks just to save every possible penny. Why are they suddenly driving this $60 billion order book for Supermicro?
Honestly, desperation. Desperation and time to market. Yeah, the hyperscalers are in a vicious arms race to provide AI compute to the world. They simply cannot afford to wait 18 months to design their own custom liquid-cooled architecture for every new chip cycle.
Wow, okay.
Supermicro has the turnkey liquid-cooled racks ready to go today.
So here's where it gets really interesting. We have a company with a $60 billion backlog fueled by the biggest tech companies on Earth, a proven ability to double their margins to 15 to 17%, and a distinct engineering moat in liquid cooling and speed market.
Sounds perfect.
Yeah, but the financial chart looks completely disconnected from reality.
It really does. The valuation multiples are severely compressed. The trailing 12-month price-to-earnings ratio sits at 15.82, and the price-to-sales ratio is an almost unbelievable 0.5857.
That's crazy. In the broader AI sector, you routinely see software companies trading at 15 times their total sales, let alone their earnings.
Right. A 15.8 PE ratio implies the market expects absolutely zero future growth.
It's the kind of multiple you assign to a company selling, like, toothpaste.
Exactly. And looking at the price action, the stock is trading at 31.20. It suffered a 50% collapse from its 52-week high of 62.36 back in July.
But it has also rallied hard off its March low of 19.48.
Yeah, and that recent rally is crucial. Over a recent 5-day window, the stock posted a 23.8% return, and it happened on immense volume.
What kind of volume?
The 10-day average trading volume spiked to over 43.6 million shares.
Okay, moving 43 million shares in a few days. Isn't retail investors trading on their phones on their lunch break? That requires serious capital.
That volume signals heavy institutional accumulation. Mutual funds and hedge funds stepped in aggressively to buy the dip following that preliminary margin beat.
So the smart money is moving in.
Basically. The analyst notes suggest the broader market got far too pessimistic. Furthermore, having a $60 billion order book provides massive working capital absorption.
Wait, explain working capital absorption for me. Because if I suddenly get an order for $60 billion worth of supercomputers, I have to buy all the raw materials first. Wouldn't that bankrupt a company with a $19 billion market cap?
It would, yeah, unless you have highly efficient cash conversion and prepayments.
Oh, I see.
Because the demand is so intense, clients are often required to put down significant capital up front just to secure their place in line.
Okay, that makes sense.
Combined with supply chain financing, Supermicro can fund the building of these racks without needing to go to the market to issue new stock.
So they avoid diluting their existing shareholders.
Exactly, which makes that 15.8 PE ratio look even more fundamentally undervalued.
We have painted a very rosy picture of the upside here, but a stock doesn't get cut in half by accident.
No, it does not.
Let's flip the perspective. To get the full picture, we really need to hammer on the downside and the bear case. What forces could completely derail this bullish setup?
It raises an important question about the macro environment and execution risk. First, we have to scrutinize those margins.
Right.
Yes, the preliminary Q4 update showed 15 to 17%, but the trailing 12-month average is still anchored down at 8.39%.
Okay, so the core argument from the bears is that this recent quarter might be an anomaly.
Precisely. What if a temporary shortage of a specific component allowed them to just, temporarily gauge prices?
Right.
If this isn't a structural permanent shift and margins collapse back down to 8%, the market will ruthlessly reprice the stock downward.
Yeah, if you're valued as a high-margin business and you suddenly revert to being a low-margin assembler, institutional money will flee instantly.
Oh, immediately.
But beyond their internal execution, they're also incredibly sensitive to global macroeconomics, right? There's some serious geopolitical tension in the background here.
The geopolitical headwinds are escalating, particularly concerning conflicts involving Iran and regional proxy groups. This instability is putting immense upward pressure on global energy markets.
Pushing oil prices past the $90 to $100 per barrel threshold.
Exactly. And whenever oil spikes to $100 a barrel, inflation inevitably follows.
Right. Logistics, shipping, raw materials, everything becomes vastly more expensive across the entire global supply chain.
And when inflation spikes and operating costs soar, enterprise companies immediately look for ways to protect their own profit margins.
Yeah, and the very first thing they slash is their IT spending budget.
You got it. The nightmare scenario for Supermicro is that capital gets tight, and the companies driving that $60 billion order book suddenly decide they need to delay their hardware upgrades for another 12 to 18 months.
An evaporating backlog would be absolutely catastrophic.
It would.
But I want to press hard on a different data point from the risk profile because, frankly, it looks alarming to me.
What's that?
The insider flow data. Over the last 90 days, corporate insiders, so the executives running the company, have sold a net total of 624,563 shares.
Yeah, that is a big number.
I am struggling to reconcile this. If they're sitting on a $60 billion gold mine, their margins are structurally doubling, and they have this massive moat in liquid cooling. Why on earth are the people inside the building dumping over 600,000 shares?
I know.
That doesn't just warrant caution, it looks like a blaring fire alarm.
It is arguably the strongest piece of evidence for the bear thesis, and it absolutely demands scrutiny. When the people with the most intimate knowledge of the company's daily operations are reducing their exposure, investors naturally get spooked.
Right. So what's the defense for it?
The defense often points to the cyclical nature of hardware. Executives in this sector have been burned by boom and bust cycles before. So standard corporate practice often mandates taking heavy profits after massive historical run-ups, almost regardless of what the future outlook is.
Okay, so they might just be locking in their own wealth because they know how fast the hardware cycle can turn against them.
Exactly. But we have to balance that insider selling against the massive institutional buying we discussed a moment ago.
The 43 million shares in volume.
Right. Yes, insiders offloaded over 600,000 shares. But the broader market just absorbed that supply and pushed the price up 23.8% anyway.
So the institutions are essentially acting as a sponge.
Yeah.
They see the insiders selling and are effectively saying, we don't care, we will happily buy your shares at this discounted valuation.
The sheer weight of institutional demand is vastly overpowering the insider distribution, completely absorbing that selling pressure and forcing the momentum back to the upside.
Wow. Okay, so what does this all mean, ultimately? We've got a company poised for explosive fundamental upside, completely at odds with the depressed chart, but balancing precariously against the threat of inflation and volatile hardware cycles.
This tightrope.
Looking ahead over the next 1 to 3 months, what are the actual catalysts? What events will force Wall Street to finally make a definitive decision on how to price this?
Well, if we connect this to the bigger picture, the upcoming calendar is loaded with inflection points.
What's first?
The most immediate catalyst is the official, finalized Q4 earnings release. This is the moment they have to show their cards.
Right.
They must definitively prove that the 15 to 17% gross margin was a structural evolution, not a one-off fluke. They also need to provide clear visibility on their manufacturing capacity.
Because an order on a spreadsheet doesn't mean anything until a liquid-cooled rack is sitting in a data center and the client's check actually clears.
Exactly. How fast can they turn that $60 billion backlog into recognized cash? That's what the market wants to see.
And what follows the earnings report?
We'll be closely monitoring the deployment ramp of that new H15 server portfolio. As the hyperscalers physically integrate these AMD 6th Gen EPYC systems, we'll see if the massive performance advantages secure long-term, sticky contracts.
That makes sense.
We also have to watch for a broader macroeconomic rotation.
Oh, like capital moving between sectors.
Yeah, if capital starts rotating out of defensive or energy sectors, that liquidity historically seeks out high-growth tech stocks trading at steep discounts.
And there are also some unconfirmed rumblings regarding the hyperscalers too, right? Speculation about potential multi-year locked-in contracts with major cloud providers who are realizing they just can't build these liquid-cooled architectures fast enough in-house.
Right, and while those remain purely speculative right now, the sudden, violent expansion in their margins heavily implies they're successfully negotiating with much higher-tier clients.
So putting it all together for the final verdict, synthesizing the technicals, the fundamentals, and the macro risks, the data assigns this setup a bullish score of 8 out of 10.
An 8 out of 10 is very solid.
It is. The targeted strategy suggests a highly favorable 1 to 2 month swing trade leading into the earnings confirmation, designed to capture the upward momentum of the margin beat.
But the real prize here is the potential for a multi-year hold.
Long-term view.
Exactly. Because if they demonstrate that this structural shift in profitability is permanent, you are essentially buying a hyper-growth, dominant AI infrastructure leader for a P/E ratio of 15.
Which is just wild.
If the underlying business has truly evolved, the current valuation will be viewed in hindsight as a bizarre historical anomaly.
Which brings us entirely into focus as you analyze your own strategy. We spend endless hours discussing the software side of the AI boom, right? The language models, the generative apps.
Oh, constantly.
But those companies command sky-high, totally speculative premiums. The infrastructure builders, companies like Supermicro Computer, offer a fascinating backdoor approach.
It's a potential strategy to capitalize on the sheer, unstoppable physical build-out of the AI sector without paying the exorbitant prices attached to pure-play software giants.
And that dynamic leads to a deeply compelling long-term concept to consider. Think back to the utility companies we discussed at the very beginning of the talk today.
Boring, but essential.
Exactly. Without the power grid, the entire modern digital economy grinds to a halt. It's the ultimate bottleneck.
And if
For the last 10 years, massive software companies have completely dictated terms to the hardware builders. But if the physical architecture becomes the defining bottleneck for the future of technology, we might be witnessing the exact moment where the builders finally take the power back.
the supposedly boring utility company might end up having the leverage to charge whatever it wants just to keep the lights on.
It completely flips the script on how we view these charts.
It really does. The slow-moving infrastructure play might just be the actual rocket ship. It's an incredible concept to mull over as we wait for those final Q4 earnings to drop.
Absolutely.
Well, that's going to wrap up our analysis for today. Remember, if you enjoyed this, please subscribe, like, and comment underneath.
And definitely click that VIP Algos link in the description below for more top-tier market insights. Catch you next time.